Natural gas markets are heading into the summer under pressure. This isn't just about air conditioners running overtime. A mix of tighter supply, increased power demand, and rising exports means natural gas is in record high demand. Let's break down what's happening and what investors should watch out for. Natural gas is still one of the cheapest energy sources in the US, but several factors are straining its supply. First, the US ended the winter heating season with gas inventories at a 3-year low, following a colder than normal winter that cut into reserves. And the US Energy Information Administration expects that inventories will get even tighter. This chart shows the gas inventory range over the past 5 years, the 2024 levels, which were at the higher end of that range, the inventory for 2025 to date, and the expected inventory for the remainder of the year. As we can see, the expectation is that by October, supplies will be below the 5-year average range for the period and much lower than 2024. At the same time, electricity demand is rising. The Federal Energy Regulatory Commission expects power generation demand to rise this summer, driven not just by demand for cooling during the summer heat, but also by increased electricity usage from data centers. Exports are also growing, especially for LNG, which hit a record in March 2025, closing the month up almost 24% from a year ago. The US is already the top global LNG supplier, and new terminals will help increase exports, especially as Europe and Asia seek to lock in alternatives to Russian supply. Finally, there's the weather. An active Atlantic hurricane season could disrupt gas infrastructure along the Gulf Coast, which handles the bulk of US LNG exports. So what does this mean for investors? First, shareholders in companies that produce natural gas could benefit because producers, particularly in shale-producing regions, can come out of this as winners. Companies like Cheniere Energy, Chevron, and ExxonMobil are companies investors can watch. LNG shipping and infrastructure companies also stand to gain from the longer-term growth in global gas markets. New terminals will also ramp up exports. Golden Pass, a joint venture between Qatar Energy and ExxonMobil, is expected to start operating in late 2025. And Plaquemines LNG, owned and operated by Venture Global, has started producing LNG and is expected to start commercial operations by late 2025 or early 2026. So what's the flip side? Industries that consume a lot of electricity could see costs rise. That includes AI data centers, which are growing fast and putting pressure on the power grid. Consumers may also feel the pinch. If gas prices spike, utility bills could rise, especially in regions that rely heavily on gas for electricity, like Texas and the Northeast. The Energy Information Administration expects the U.S. monthly bill for residential electricity this summer to average $186. That's up from $180 in 2024 and $167 in 2023. Last year, U.S. natural gas consumption set new winter and summer monthly records in January and July, according to the EIA. Growing demand for the fuel and rising exports may make those records easier to beat.